Hey guys, what's going on? It's Lewis here with Crypto Elite, and in today's video, I'm going to be going over a couple concepts that I have been learning about very extensively over the month, and I've been diving into these things every single day for hours and hours and hours, and I was about to make a market update video, and I thought to myself, okay, well, let me just explain these concepts about trading before I get into the video, and so I made this video, and it took me like 45 minutes. So I figured might as well just put it up as its own. So this is going to be a video talking about a few trading concepts. And then right after I upload this, I'm going to make a market update video. So you could look out for that. So I just wanted to share this. And also I want to share that I may be actually partnering up with a new exchange called MEXC Global, because I know that there will be a lot of hidden gems available for people during this bear market rally, or excuse me, during this bear market, that if you get into them super early, it could be similar to getting into potentially getting into the early ones from 2018, 2019, and those did 100x. A lot of those did 100x. Quant, my favorite. There was Phantom, there was Matic, there was Solana. There was a lot of these things that, you know, went up 100x. So you put $1,000 into one of them, you made $100,000. You put $500 into it, you made 50 grand. Even if you put $100 into it, you know, you still made substantial amounts of money because they went up so much. And I don't know which ones are gonna, you know, do that 100x next cycle, if there even is a next cycle. I think there will be. I do know that I want to be able to get them, and also I want to be able to work with an exchange. And so I haven't finalized anything yet, but I do think that MEXC will be the sponsors of the videos. And so personally, I think that's super exciting. And also I am working on my course. So I'm gonna give you a sneak peek into what I've been working on in my course right now, and then we could start talking about the different trading concept. I'm going to get to that right now. I'm going to take myself off of the screen because my camera has been a little wonky lately. So I'm going to take myself off the screen and then get to the video. And yeah, hope you guys enjoy this, and then watch the market update video, which should be coming out shortly. Okay, so I'm off the screen now. And the first thing that I want to talk about is that I haven't been making as many updates lately because I've been working super hard on a video series for my course, the upgraded version 2.0 of the Crypto Mastery course. So I have my risk management videos down. You could see like I cover a lot in this stuff, like all of these things. And down here at the bottom, like these are a lot of slides. You know, this takes me 30, 40, 50 hours per video, and I have the risk management video down. I finished the how to do your own research video, which has a ton of information, just like tons and tons of charts and things. I got the fundamentals of trading video down, and I have the market structure and order blocks. This is what I'm working on right now because I finished up the support and resistance, and you can see I have all these slides for the support and resistance and the market structure and order block videos down as well. So I'm working on all of this for the course. However, during these videos, I plan on giving out a lot of information that is within all of different slides. I'm going to be, you know, providing educational content in my market update videos. This is the reason why, you know, I've been taking so long, is because it's been, you know, I've been making these slides and recording videos. It takes me 100 hours sometimes to make these things. And I'm sort of like a perfectionist with this. So things have to be basically perfect before I release it. And anyway, that's what I've been doing. So with saying all of that, I think we could get into the charts, and I'll go over some of the concepts like ranges and order blocks and market structure and all of that stuff. And then we could plot out some trades. We luckily caught a couple long positions like Ethereum from 1532, 1524. And this was great, but the price ended up rallying way above the take profit. I did get into Bitcoin after I took my profit from Ethereum because Ethereum never came back down to where I wanted to get in after this was hit. But I did get into Bitcoin, so that was good. But I don't want to be leaving so much profit on the table. So that's why I am doing these market updates, which should help both you and me, because all of the concepts that I'm going to be talking about can help determine when to get into trades, when to get out of trades, and when to be more aggressive in your take profit taking and when to be more conservative in your profit taking. And so right now, what I'm going to do is I'm going to go over the concept of market structure, and then we could get into the actual charts. Okay, so we're going to have a quick lesson on market structure. And if you don't want to look at the lesson, you could just skip. There will be timestamps for when this is over, but let's just go over this really quickly. And so talking about market structure, there could only be 3 different phases to the market where it's going up, it's going down, or it's consolidating and it's within a range. And so in bullish markets, the price consistently higher highs. So you could see that this was the high and then it broke that high. This became the new high. This is now the new high when it broke this high. And then of course the opposite is in bearish markets or downtrending markets where we have a low and then we have a lower low and then we have a lower low. And then in consolidation markets, there's simply a high and then a low, a high, and then basically a low at the same low, a high at the same high, a low at the same low, a high at the same high. And it's never exact, but the price just continually bounces between the area of demand and the area of supply. And so here's the deal. When we're in an uptrend and then we reverse into a downtrend, let me bring this down like this and bring this down like this. Smart money, big money, and market makers. The market makers are the ones who reverse the trend, okay? And we have to catch on to this. And so one thing to know is that this right here, this could be on the daily chart, and this whole thing could be on the daily chart, right? But within these daily chart candles, the same thing is happening on the smaller time frames. Maybe on the 4 hour, it looks something like this, okay? Where it goes up, down, up, down, up, down, and the trend is up, but within the uptrend, there are some downward retracement. And so let's say that the daily trend looks like this, right? But then on the downward trend, on the 4 hour trend, it might look something like this, where it's going down. Well, what you need to know is that the overall big trend is moving up, right? It's been moving up. Why? Because we broke the market structure to the upside on the daily chart right here. So you want to get in when the price goes down on the lower time frames and then starts to reverse upwards on the even lower time frame. So for example, this right here, this downward action might be on the 4 hour time frame, and you might also get something like this happening on the 4 hour time frame. So if this happens on the 4 hour time frame, then you would want to get in on the retest right here and then get this move up to the new high. But this is on the 4 hour. So maybe on the 15-minute chart, if you zoom in enough, this right here, this down followed by this move up might look like this on the 15-minute chart, okay? If this is happening on the 15-minute chart right here, and this is happening within this area right here, and if you look left, you could see that this was a high time frame resistance, now support. Then when the market structure breaks to the upside on the lower time frames, whether it's the 4 hour, the 1 hour, the 15-minute, whatever, then what you could do is you could plot that out and say, okay, this is a market structure break to the upside. So you want to get in right here on the lower time frame chart, which if we're looking at it right here would probably be somewhere right around this area, if not maybe a little bit lower. And that way you'll catch the meat of the move up to the new high. So to sum it up, an uptrend is when we experience market structure breaks to the upside. And a market structure break is simply making a higher high, a high after a high already formed. A swing high forms, and then we break that to the upside. That means that we are now in an uptrend. So you want to get in, not at the high, not at the new high, but on the retrace. So where do you get in on the retrace? That is the question. Because maybe it retraces to here, maybe it retraces down to here, or maybe it retraces all the way down to the bottom and makes an equal low. As long as it doesn't break this low, we're still in an uptrend. Granted that we break the previous high. And so to know where to get in, that's when you look at the higher time frames and you say, okay, well, this was the previous swing high. So there's going to be some support / resistance and SR flip area. So that's a good area to get in. And if it does happen to fall below this, where else can we get into? Well, we could get into it at the fib levels, either the 61.8, the 78.6. And if none of those work out, then perhaps we could get in at the swing low. And so you might want to just place random random bids right here at the previous resistance turn support, or at the 61.8, or at the swing low. Or what you could do is you could zoom in from the higher time frames into the lower time frame charts, wait until we are in areas of interest. And so if you're buying, you want to buy in the support area of interest. If you're selling, you want to sell at the resistance area of interest. And you could zoom in to see the fractals that are happening inside of these areas. And then if you happen to see something like this on the lower time frames where we are going down and then we switch to going up, then you could get in on the lower time frames on a little bit of a retrace before the price eventually ends up back up all the way and making the new high. This right here would be on the 15-minute time chart. If this was, say, the daily or the 12-hour chart, you could see this happening in this support area of interest, and then you could get in with a very, very good risk to reward ratio. And that's what makes this so powerful, is that yes, you might say, okay, I'm going to take the Fibonacci from the bottom to the top, get in at the 61.8, and that's going to be my entry. So I'll get in at the 61.8, but then where are you going to put your stop loss? You know, you could put it underneath the 78.6, and that does work out very well most of the time, or a lot of the times at least. But a lot of the times the 78.6 is fairly far away from the 61.8. Or there might be a wick down right below the 78.6 that stops you out, and then it wicks back up to the 61.8. So if this was how you were going to enter a trade, you might enter it like this and have a 4.55R setup, and maybe the price comes down and it hits the 61.8 on the dot, and then it rallies up to your take profit and you get that 4.55R trade, which is amazing. But what if you plotted this out as a support area of interest, and then when the price came down in there, it did something like this? Then you could put your stop loss at a definitive level underneath a certain candlestick that fits your parameters, and maybe the risk to reward ends up being something like a 10 or even better. And the higher the risk to reward is, the more capital you could put into your trade. And it's always about how much capital you put into your trade, because your risk per trade should remain constant. But if you have a better risk reward, you could put more capital into it with risking the same amount as if you put less capital in and you had the risk reward be less than the other trade. And hopefully that wasn't too confusing. And on the opposite side, when there is a trend reversal, let's say the price is going up, it goes down, it goes up, it goes down, it goes up, and then it comes back down, all the way back down, and it breaks this market structure, right? This is now a bearish market structure break, a bearish MSB. So you want to look for shorts now. So maybe you look for shorts on the way up, and you could take your Fibonacci from, let's say, the top to the bottom, and you could look for the 61.8 and take your shorts there. But what would make this an even better opportunity would be if you got into your short position somewhere up here, or somewhere, let's say, over here, because this might be on the 1 day time frame, right? And let's say that overall on the higher time frame, this area right here, which is the resistance, this used to be major support. So it became the major resistance. And this is on the 1 day chart or the 12-hour chart. So what if in this area of resistance, aka the resistance area of interest, you zoomed in and you saw something like this happen, where the price was continually going up, and then eventually it did this, right? And it broke the market structure, and it continually broke market structure on the way down, meaning that it broke market structure on this candle down, it also candle down, and eventually it broke this candle down. So if you start seeing that it's breaking market structure within the area of interest, in this case the resistance area of interest, then you could put on a short position, and you could put on a short position with a very tight stop, meaning that your RR will be a lot better off than if you waited until the price came all the way down and then came all the way back up to put on a trade where your RR might not be as good. And so the main concept that I'm really trying to push home here is that you should firstly plot out the range. So the range low and then the range high. And then you should look for areas of interest to form so that you know where the highest probability trade setups occur. And then you could zoom in to the lower time frames and look for these market structure breaks to get some really, really good RR trade setups. And you can not just look at the market structure breaks, but you also look at the candles and you look at the formations and you look at a whole bunch of other stuff, which we'll get into in other videos. But that's the main purpose, right? And so this was in the uptrend, this was in the downtrend, and in the consolidation, you could do it as well, where you say, okay, in this area, I'm going to be looking for longs as long as the price is somewhere right in this area. And I'm going to be looking for shorts up in this area right here. So I'll just make this red because this up here is the supply zone. There's a lot of supply up here. And this down here is the demand zone. There's a lot of demand down here. So I want to be looking for price action to develop that makes me have a long bias within the big area of demand, which is basically the support area. And then you simply play the range. And that's basically what people mean when they say that they're going to trade the range. And that's also what people talk about when they talk about market structure and market structure break. So now let's talk about order blocks, and then we could get into the actual analysis. Okay, so we're going to talk about order blocks now in the context of market structure and ranges. We start off by plotting the monthly ranges. So let's start off back in June, okay? Because June, it's a pretty ridiculous range. So we have the monthly high right there, and we have the monthly low right there. So this is the range for June. Then what happened is July happened, and the range for July became right here and right here. And so I moved on to July because there was really nothing to do when it came to June, because the high was all the way up here, the low was all the way up here, and the candle close and the wicks, everything was inside of June's body and candle. So this couldn't really do anything on the monthly time frame. And so that's why I went to July. And now let's go to the weekly time frame. And for the weekly time frame, even if you did include June, the high was all the way back here on the swing high, and obviously it got nowhere near there. So let's just stick with July. And if we look at the dates, we can see that this was July's high, and we know that July's low was right here. Actually, just going back to the monthly real quick, you could see that there was a swing in August above July's high, and eventually August ended up closing all the way down there. And if we go to the weekly, you could see that the swing high was above it. It occurred on August 8th, or the week of August 8th. And then there was another swing high failure pattern, and then the close down here. So that's on the weekly, and you could probably think, okay, well, this whole area right here, this whole area is the resistance area of interest that I want to look at because it's July's high. So when this initial swing failure pattern happened, that should have been enough to be able to say, okay, I want to go into the lower time frames and look for something, look for that candlestick pattern to form, and look for that fractal to form that we talked about down here, where it looks something like this. Because if something like this forms in the area of resistance, or the resistance area of interest, then that would be enough to get in. So that was right around here. And if we zoom up, we can actually bring this right here, and this right here was July's high. And you can see lots of swing failure patterns above July's high, but no close above it. So let's say you saw this, and then you saw this, and then you saw this. You just keep on seeing these swing failure patterns. Well, what if you go down into a lower time frame? Where do you want to get in? Well, like we talked about before, you want to get in on a retest of the market structure break. So remember, if we go back down here, this right here is the market structure break down. And so we want to get in the short position on a retest of this market structure break. And so right here, this move up, if this is a candle, we want to get in at the low of this candle. And so if you take this area right here and you draw it out, you can see this is the down move. So this is the down move right here. And then this is the up move, and this is the up up move right there. And then this is the down move that broke the market structure right there. So these red candlesticks represent this move down that broke the market structure right there, right? So where do you want to get in? Well, you want to get in where the market structure was broken. You want to get in on the lowest point of the last up move for the move down. And that up move right there is the bearish order block. So this right here, this up move before the move down that broke this market structure, this is a bearish order block, okay? And so a bearish order block is the last up move before the move down that broke the market structure. And so you want to get in on the candle that moves up into the bearish order block and then hope that the price goes down so that you could take profit on your short position. And so that is a bearish order block. And so let's look for a bearish order block. And remember, we want to have the bearish order blocks in the resistance area of interest, or the resistance AOI, or I'm just going to start talking and say that's the RAOI. So RAOI, resistance AOI, that should be somewhere up here. So let's zoom in and see if we could see anything. Because remember, first, using top-down analysis on the weekly time frame, the first week of August wicked above July's highs and then closed back below it. And then if we go down to the daily chart, this is the July high, and you could see there was a wick above it, a wick above it, a wick above it, a wick above it. So that's already a lot of confluence saying, okay, this is going to go down because we just keep on getting these swing failure patterns above July's high. And eventually the price did end up tanking down. And if you look at this on the daily time frame, what does this look like? This looks something like up, down, up, down, up, down, maybe up, maybe down, like this. And then this move was literally the entire move down, was this whole thing, right? So whole move down broke market structure right there. It broke market structure right there. It broke market structure right there. And it broke market structure right there. So if we're looking at the last up candle or up move before the down move that broke market structure on the daily time frame, this would be the bearish order block right there. But obviously it never came back up to that. However, remember what I talked about when I said that, yes, this whole move might be on the daily chart, but on the 4-hour chart or the 1-hour chart, it looks something more like this, right? And that's what I talked about right there on the lower time frame charts. It looks something like this. So if we start seeing market structure breaks and a possible reversal on the lower time frame charts in the area that we noticed had a swing failure pattern on the weekly, and then on the daily also had multiple swing failure patterns, perhaps we could get in on a bearish order block on a lower time frame. So let's check the 12-hour. And on the 12-hour, this is what I see. I see a move up, a move down, down, up, down, up, down, up. And then finally down, move up, and then a move. So this move down right here, what market structure did that break? That broke this market structure. You could see it kept on making higher lows, higher lows, higher lows, higher highs, higher highs, higher highs, got into the area of resistance. And then all of a sudden, boom, it made a lower low and broke this market structure, the market structure break. Where would you want to get in if this was the 12-hour? Well, I would say that this move right here was the final up move before the down move right here that broke the market structure. So I would want to get in on a retest of here. However, check this out, 12-hour time frame, never hit it. It never actually got back up here. What about on the 4-hour time frame? Because remember, there's fractals inside of fractals inside of fractals. So let's go to the 4-hour time frame and see if there was an opportunity to get in that time frame. And so looking at the 4-hour time frame, I could see something like this, where it's going up, down, up, down, up, down, making higher lows, higher highs, higher lows, higher highs. And then first off, right here, this candle right here was the first one that broke market structure. So maybe you would want to get in, for instance, somewhere within this box, because this is within the resistance area of interest. And there is that break of the market structure with this down candle. So this is the up move before the down candle broke the market structure, right? So you could have gotten in on this candle. However, you possibly might have gotten stopped out right there if you decided to do that. However, right after that happened, the price fell down again. And what ended up happening, boom, market structure break underneath this particular pivot, which now means that this candle right here is the last up move before the down move that broke the market structure to the downside. So this is the bearish order block. So you would want to get in at the bearish order block with the stop loss above it, and your target would be well down here. And so after this candle formed, we had multiple retests of this bearish order block over and over and over and over again. So this is on the 4-hour time chart. So let's look at if we put on a trade on this time frame, we would do something, we could do something like this, but this is only a 1-hour trade, so that wouldn't work out. We would look back and we could say, okay, this was the low. Remember, this was July's low, this was July's high. We sweeped the highs, and now we're coming back down. So potentially you could just target the lows, which is a 4.56R trade. That's awesome. Or you could target the mid-range, probably somewhere right around here for a 2.5R trade. That's really good as well. Or you could stack your take profits, one down here at these swing lows, one at the midline, and one at the range low. And so let's say that you're a god tier trader and you just said, I'm going to target the range low on this particular trade setup. That is a 4.64R trade using this order block on the 4-hour time frame. However, what if we go down to the 1-hour time frame? Well, I don't want to get too technical with it, but I do see on the 1-hour time frame, this right here and this right here, these are equal highs, right? And then this candle wicked above it. So it had a higher high, but then it eventually went down and it broke the market structure right there of this market structure, right? Which means that if we zoom in, this up candle before the down move that broke the market structure is actually a bearish order block. And typically when you see equal highs and then the liquidity get run and then there'd be a break in market structure, that typically makes for better trade entries. So this would become the entry right here with a stop above it. And that would make this trade over a 9R trade, possibly even a 10R trade. And so that's how accurate you could get if you go down into the lower time frames. And of course, it doesn't work every single time because right here, you could see this was a market structure break. So this was a bearish order block originally, and eventually this bearish order block would have gotten stopped out. But if you enter into a trade and it's a 10R trade, that's obviously going to make up for much more than the loss that you incur on your previous trade. And so those are examples of bearish order blocks. And what we could do is we could also look at bullish order blocks now. And so I drew out a bullish order block scenario for you. Let's say that, look over here, we're in a downtrend. We're just trending down, trending down, trending down. And then eventually we broke up, right? And we broke the market structure right here. So a bullish order block would be somewhere within this range. And this is where you should get in. So a bullish order block, the last down move before the move up that broke the market structure, that is within the bottom. You should be able to see this somewhere at the bottom. So let's say that this is the 12-hour chart. Maybe on the hourly chart, it looks something like this, where we got the move down, and then finally, boom, a move up that, if I take this, broke the market structure to the upside. And so what do you want to do? You want to get in on the retest of the move down before the move up that broke the market structure. So in candlestick form, it looks like this. There's a move down, a move up, a move down, a move up, a move down, and then finally a move up that broke this market structure right here. So it broke this market structure, which means that this candle, the move down before the move up that broke the market structure, this is the bullish order block. So what you want to do is you want to wait for the price to come back down to the bullish order block before it makes its move up again. And remember how I said that you want to look for bearish order blocks in resistance areas of interest? Like this used to be support, 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 and then it turns into resistance. So you'll look for a bearish order block. Well, you want to look for bullish order blocks in support area of interests. So for instance, this was the entire move right here. Then this whole area down here, this would be support. This whole area is support because it bounced off support once and now it's coming back down into the support. So if we see this type of formation on the lower time frames, something like this, where it came down and then it, did that, then we know, okay, we want to get in at the bullish order block and we will have a predetermined predefined risk. So we'll know exactly how much we'll lose and we'll know if our trade idea is wrong. So if that's the case, let's look for that in the charts. And so you see, using top-down analysis, that we have July's lows right here, and they were ran, and then we had a base form before the move up. I'm willing to think that somewhere within these candles on a lower time frame, there is a bullish order block, and that was respected. And so you could see on the 15-minute chart that we had a low, a high, a lower low, a lower high, a lower low, and then a high, a higher low, and a higher high. And this is all happening right underneath the support area of July's lows. And so this move up broke this market structure right there to the upside. So I would look for the last down candle before the up move that broke the market structure. And you could use this candle right here, or you could use these candles right here. It doesn't really matter either or. I'll use this one and I'll say, okay, this candle right here was the down candle before the up move that broke the market structure to the upside the first time since really up here, because we just been making lower highs every single time. And then finally we made a higher high right there. So this is the bullish order block. And what do? You get in at the top of the bullish order block and you have your stop loss underneath of it, or I'd probably put my stop loss down there. And then what would you do? You would target, wherever you want to target. You could go back to the 12-hour and say, okay, this is the range low of the 12-hour. So maybe I'm going to look at the range high and target all the way at the range high. Look at how insane that is. I doubt anyone would actually do that, but that's a 32-hour trade. Although what I would do is probably take some profits right around there. And then I'd probably take some more profits right there, and then I would take some more profits right there, and then I would probably take the rest of my profits. Probably right here is where I would take the rest of my profits, because this is around the midline and there's a big support resistance area, and there's just reasons to take profits here. But this is a 17-hour trade. This is absolutely insane, right? So you could see just how crazy this strategy could actually be when you're using bullish order blocks and things of that nature in order to put on trades from the lower time frames, and then you use the higher time frames to get your targets. And so going to Ethereum, for example, you can see that this area right here was the area of support. So this is a big area of support. So if anything happens within this area, I would want to look for longs. And so zooming in to the 15-minute chart on Ethereum, you could see that we had lower lows and lower highs just consistently until finally right around here, we had a higher low, the first higher low, and then we had the break in the market structure right here. Well, here we have lower lows, lower highs, and then finally a break in the market structure right there. Well, as soon as this move up broke above this right here, so it was down, up, down, and then up, and it broke above it, market structure break, I would say, all right, well, market structure break, this right here is the down move before the up move that broke the market structure. And so remember, the way I'm looking at it is as if the price is going like this. So this is the down move right there, and then this is the move that broke the market structure. So I want to get in on this down move. Okay, so I get in right here, and I would say this would be my trade. I'd put my stop underneath the lows, and where I would target, look at the higher time frames, and you could have the previous support be your first target for a 4R trade, or you could have this be target 1, and then the previous resistance, big resistance level, be target 2, and that's a 9.44R trade. So you can see just how powerful this is if you do it at the correct times. Of course, there's going to be a lot more times where you could see order blocks forming, such as somewhere within the range, but I wouldn't necessarily want to take bullish order blocks anywhere up here because this is clearly a resistance area, right? So I wouldn't want to take a bullish order block even if I saw one on the 5-minute or the 15-minute chart. I'd rather look for bearish order blocks because this is the resistance area of interest. And same thing for down here. I would only want to look for bullish order blocks somewhere down here because this is the support area of interest. And so that is the lesson on order blocks. And now that we know that, and we know market structure, and we know a little bit about ranges, we could actually do the analysis. And by the way, I'm going to throw this disclaimer up, but I'm not doing my analysis in this video. Obviously, this video has gone on for way too long. So I'm just going to end this video right here, and then I'll do the market analysis up next. All right. Thanks for watching. You're awesome. See you in the next video.